we have seen over a period of time that the prices go up drastically beyond a level and then they correct. So the only way out is to invest in good companies with robust businesses, with solid economic moat. Steady growth is the best way to compound your wealth over a long run, not that overnight sensations and then they are nowhere. Over a longer period, stock prices align with the business's true performance. So actually, even if the stock prices go up too much, they correct. Or there is a pre-contraction, etc. comes it, and finally it has to align with earnings. Short-term drawdowns present opportunities to buy stocks that will grow your wealth exponentially. Finding these stocks is only half the battle. Real test is discipline to hold on to them through markets ups and downs. Now, market outlook. This week was very interesting. Uh, Firstly, there was a lot of euphoria during this week. Once the Fed signaled that there is a 100% possibility of a September rate cut, and then nervousness came during the week after that, because Powell mentioned the possibility of a rate cut during his press conference. U.S. bond yields fell, US dollar weakened, and stocks soared. Next day, the bond yields went lower, equities fell sharply on worries of slower growth, and volatility shot up. That is, the VIX shot up. Now, US economy is indeed slowing much more rapidly than expected. On Friday came confirmation that US economy is slowing rapidly than expected. Non-farm payrolls for July came at 1,14,000 while estimate was 1,76,000. Unemployment rate was 4.3% against estimate of 4.1%. Probability of Fed rates to be lower by 100 basis points from current level by December this year jumped to over 80%. That means people are factoring 3 rate cuts this year only, a 50 basis point immediately followed by 225 basis points in November and December. US bond yields plunged, as did the US dollar. Stock futures and commodities also came down while VIX and gold shot up. US ISM manufacturing PMI, a gauge of manufacturing conditions, fell to 46.8 in July, signaling not just contraction from the previous month, but contraction at an accelerated pace, which is clearly indicating to them that there is a chances of a stagflation or a recession. Why stagflation? Because the sub-index for jobs went down, while that for selling prices firmed up. Hence, the risk is of a stagflation because inflation remains higher and the growth is not there. Purchasing activity is falling, hiring has slowed amid concerns over weaker than anticipated sales, and all this happened within 2 days. Uh, while rate cuts lead to soft landing, or will rate cuts lead to soft landing, or whether they are needed to avert a recession? The thought process was that there would be a decent slowdown in inflation and the economy will not slow down and then they will start cutting rates, but that never happens. And now what is happening is that the economy is getting into a recession and now there is a lot of worry. So it seems that the Fed made a mistake in not cutting rates at their last meeting, and now again it is behind the curve, like it was when the rates had to be raised, because they waited to the last moment and all. And now again the same thing is happening, and now they will err on the higher side. Another question worrying the US market is whether the AI bubble is bursting. ARM, Qualcomm, and Intel fell after providing weak third quarter outlook. Intel said that it expected to make a loss in the third quarter and was cutting its dividend and thousands of jobs, and it fell 20% on Friday. With exception of Nvidia and Micron, higher PE has led to rise in stock prices, while only in Nvidia and Micron, the earnings have also grown simultaneously. Now, another problem is Nifty. Another issue is Bank of Japan hiked rates, which led to 8.3 4% drop in Nikkei in 2 days. Yen strengthened from 155 to 147.7 to US dollar, and Japanese companies lost the weak yen tailwind. Also, there are worries of escalation of conflict in Middle East with Israelis attacking top Hamas leader in Tehran. Okay, so what happened otherwise this week was Nifty climbed to 25,000 and Sensex took out 82,000 in spite of a consultation paper by market regulator SEBI on measures to curb speculative volumes in derivatives. So what is happening here with derivatives is bulk of recent growth in Indian derivatives has come from index option contracts and expiry date trading, which has contributed to rising activity. Now, what they are talking about is that volume to open interest is very high. Volume refers to number of contracts traded in a given period, and open interest denotes number of contracts that are active or not settled. High volume to open interest few minutes before the expiry indicates that the participants initiate and close positions within a matter of minutes and in strikes away from prevailing index level. So this is what is worrying the regulator, that the all this FNO activity is not hedging, but it is just pure speculation or punting. So what they have said is they will limit weekly option contracts to one index by each exchange, increase contract size from 5 to 10 lakh to rupees 15 to 20 lakh, and subsequently from 20 to 30 lakh in 6 months for index options, increase margins near expiries and collect upfront option premiums, disable calendar spreads. So that is one. I'll explain it later. What is a calendar spread? Uh, define the strike range as 8% on either side and prevailing index level. So it will end up reducing the number of far strikes, leading to more concentrated speculative activity, etc. So, so what is the best strategy during these times is uh, careful bottom-up investing, because if you see corporate performance for June quarter is average, rural consumption is weak, auto sales are mixed, and valuations are slightly high. Cement sector is experiencing a wave of consolidation. Ultratech this week has agreed to buy 33% stake in India Cements. Earlier, they had acquired 22.7% stake in India Cement from Mr. R.K. Dhanvarsha. So company has set sight on gaining supremacy in South India and acquired Kesoram earlier. Though this transaction is slightly at a premium, that is at $104 EV per ton to historic transaction, only consideration would be market share gain and limestone reserves. Now this is just, I'll just provide weekly statistics. If you, it's very interesting. So if you see Nifty spot, in over the last week was down 0.47, while Bank Nifty was up 0.11, gold was up 2.37%, silver was up 1.51%, crude oil went down 5%, despite so much of problems on Middle East, and because the economic forecast is poor both from US and China. So that is the reason why crude oil is going down. Natural gas also went down. Dollar corrected by around 1.1%. USD INR was generally flat, so it shows that the rupee weakened against the dollar. 10-year bond yields corrected; it went to 6.9 as we were anticipating. Market cap slightly went up, though if Nifty has corrected, that indicates that small caps and mid caps did slightly better. Market-wide position limits are higher now by 7%. After expiry, that indicates that people are taking more risk and taking more positions. The Dow Jones corrected 2%, Nasdaq corrected 3%, and S&P 500 corrected 2%. So that is basically weekly statistics. Now coming to US, disappointing quarterly results from Magnificent Seven, reversal in narrative around monetary policy hurt the sentiment this week. So if you see here, the bond yields corrected and have suddenly fallen on in this week only by around uh, 50 basis points. So they have come to around 3.8 level, and likely, so which was the last dip up to which it had gone. Now, once there is a more clarity on future trajectory of rates, it will dip further. Hence, last time also I had told that there are only two things to be watched. One is bond yields in US, and the second is dollar index. Now, dollar index also corrected and has now come down to 103 levels, and it is likely to correct further. It will go down, and now it is up below both this 20 and 50 day moving average. Brent crude, despite all these issues, still corrected and has come down to 77 level, and it is in a declining trend. So it has to be watched. If it breaks this declining trend line, it will go down to the 70 level. Gold, as predicted, was up, made a nearly a fresh high, and it's now looking very strong because of overall uncertainty and possible scenario of rate cuts. Copper is had a big fall, and it went below uh, the 50-day moving average. So it is not looking strong. It bounced back a bit, but still it got sold off from 50-day moving average. So it is not the commodities are not looking strong because of weak growth outlook. Plus, there is a lot of now copper inventories have increased in all over the world. Now Nasdaq has entered into correction zone. So if you see here, this was the rising trend line. It has broken that. So now it is below that and it's 20 EMA. So it has entered correction zone. The reason was that Microsoft and Amazon sank. 10-year yield I showed you is below 4%, and the volatility index in the US went up 42% last week to 23.39. Now coming to the Indian setup, if you see here, what is happening is that India VIX was up, and it was up only on the last day. But if you see here, it was consolidated around that 12 and 13 level, and then it shot up to 14 plus level in one day only. So that was one reason. It went up 10% on Friday only. So we'll have to see what is the trajectory, but it will always lead to higher premiums. Government bond yields, I told you, corrected, has come to 6.9 because the government borrowing is going to be less, fiscal deficit was lesser. So all these things are building into lower yields and higher bond prices. And now if you see here, the bond yields are at the same level now, which they were in March, April 23. So they have gone through the complete trajectory and come down, and will correct further once there is clarity on rate cuts and future scenario which is coming up. Now coming to Nifty. Nifty on the weekly chart made a bearish candle. The low was below the high of last week, so it is looking slightly weak, but still it is above that trend line and it is in a rising trajectory, so no need to really worry as such. It may fall to its moving averages or supports, which is normal mean reversion. So this is a daily chart. So if you see here, Nifty is looking strong, still stronger because it is above the 20 EMA, and it may test that 20 EMA at around 24,539. So that should be one level, and the next should be the support it took at on that budget day at 24,150 odd. So that should be the next support. So this has to be watched, but it is still trading above the high it made pre or on the budget day. So it is still strong. This is a 30 minutes chart of Nifty. If you see here, it was rising, made a high on 1st August above 25,000, and then it had a gap down and corrected and has come down to these levels of 24,700. So trend now is not looking strong, so we'll have to see this. So basically, we'll have to see if the US markets can take the Indian markets down, and we'll have to watch the market-wide position limits because they will indicate which side the trend is going. Now, Nifty Bank, you see, it went up a bit, and still it is above the trend line support which is there. So it's not that weakened, This was basically because of support which was given by HDFC Bank. On the daily chart, so if you see there, it went down on 3 days and was up 2 days. And on Friday, it rose up as it took support on its 50 EMA, which is at 51,000. So this support at 51,000 becomes very important, and we'll have to watch this. Bank Nifty, it was stronger as compared to Nifty. So that is the trend which has changed. So first resistance would be the 20 EMA at 51,684, and after that it can go up. So we'll have to see this. HDFC Bank, if you see here, it corrected, took support at around 50 EMA, and has now gone above the 20 EMA. So we'll see first level it will go up to is this 1680, 1670 level, beyond which there was a gap. So that should be the first resistance. And if it covers that gap, then it will go into that 1725 and other zone. So it seems right now that the correction is over, and it is making, if you see here, higher highs and higher lows. So that is a positive trend. But whether this up move is part of some positive thing happening or it is just index management, we'll have to see that. Reliance has gone below now the the basically supply zone it had breached and has come down below that, and this 20 EMA will have to be watched at 2970 68 levels. This breaches, then it will test that 2800 level. So or because this was the level it went to in that 4th June also, the budget day fall it happened. So it took support at 50 EMA. So then the 50 EMA becomes relevant here. Now, the star last week was Zomato, based on good results and good management commentary. If you see here, it has made, over a long term, it has made a rounding bottom, and then it has broken out from there. And now it is come to tested 280 yes on Friday. Now, if you see the fall, it had gone to around 40 level, and the high of this is around 160. So that is 120 points. So from this level it can go up another 120 points, which it went. So that technical uprise is over. So that 280 was achieved, and that is why from 280 it corrected. So now it will require fresh momentum from here. It is overbought also, so one has to be careful. You can't do fresh buying here right now. Now the index which was strong last week was Nifty Energy Index. Now if you see here, it is still above the budget day. Sorry, not budget day. The election day, the June 4th high, and it is looking strong right now. And it had a strong week. So this one subsector is looking strong. Midcap index made a fresh high and then corrected normally, but not that much. It just fell around 0.25% last week. And if you see here again, it is above this uh, election day high it made. So it is still strong and above all the moving averages. Similarly, with small cap index, it corrected around 0.28%. It had made a fresh high, and then it corrected on Friday basically. So let's see how the things plays out on Monday onwards next week. Now I'll cover three stocks. Uh, First is Tata Motors. What is happening with Tata Motors is that they are doing a corporate action. They are going to demerge the CV business from Tata Motor Limited, existing company, into a separate listed company, while the PV business will be merged into the existing company, which contains JLR and some other businesses. Because they have got a lot of complicated business structure. So the CV business will be renamed as Tata Motor Limited. That is the commercial vehicle business. While the personal vehicle, JLR and other businesses will be renamed as Tata Motors Personal Vehicles. US and overseas markets continue to do well, while the Europe market is tougher, while with higher discounts, and the demand in China remains muted. Because of this management commentary, I'll show you the Tata Motors stock corrected. JLR product mix continues to improve as Range Rover benefited from supply resolution and ramp up, while it also ceased production of some Jaguar models. JLR EBIT margins are likely to be higher than 8.5%, which is positive, and net cash positive guidance. CV division to benefit from resumption of infrastructure projects and thus the beginning of major CV upcycle for India, which also would be boosted by strong replacement demand this time. So that is commercial vehicles are expected to do well. And the personal vehicle would also resume its growth trajectory sooner, aided by festive demand and the expected return of EV incentives. One thing one should understand is that the major revenue of Tata Motors come from JLR, second commercial vehicles, and lastly is personal vehicle. Though we see more of personal vehicles, but actually the major source of revenue is JLR. Now, let's see their income statement. They are expected to see sales growth of around 3% FY25 and 12% FY26. Not very strong. EBITDA is likely to grow further. Margins are supposed to improve, so which will help the profits here. And if you see the EPS, what is expected is FY26 is around 1991 with improvement in return on assets and return on margin because the debt is reducing and basically the JLR debt is reducing here, and it is still at the valuation what it is. It is at PE of around 12 for FY26 expected earnings, and price to earning growth year on year growth is only 0.2. So it is relatively undervalued as compared to its peers. And there are a lot of corporate actions which are in line. There is a demerger, there is that DVR is getting extinguished. So there is a transformation which is taking place. Now let's see JLR. JLR had a year-on-year growth of 5.4, and Q&Q there was a degrowth, but it was better than estimates. EBITDA margins were still below, but they have improved a lot. And EBITDA was higher by 2%. EBITDA margins were around 15.8, so they are likely to remain in this 16 odd percent range for JLR. VME is variable marketing expenses, which they give discounts and all those things by the dealer. CVs, if you see business standalone wise, the year-on-year net sales growth was 6.5%. There was a degrowth Q&Q, and EBITDA was up by 49% because the margins, standalone CV margins improved by 320 basis points due to better realization and material cost saving because the cost of material used has decreased. So that helped them. So this is what is leading to better profit, even if the top line is not growing at that good pace. Now, if you see there, one of the brokerage has done this standalone valuation. So this standalone is the CV business, commercial vehicle, that is valued at 363. PV or EV is valued at 196 and JLR at 662. So total is around 1220, taking out debt and other issues, and stake in finance and Tata Technologies, etc. So the SOTP is 1265. So it is slightly higher than the present price. The demerger is planned from 1st July 25. So there is a clear year to now get that through. So if you see the chart, it went up based on the demerger news and all. Then the results came, and because of the management commentary was weak, it has corrected. But somewhere close between this 1000 to 1050 should be a good level to accumulate this stock, as even the RSI is going down now. So that is the reason. Actually, the Friday's fall was more because of market correction, but still, so this fall should be a good opportunity to buy a business for a long term, which has a good growth, considering the JLR and the commercial vehicle business. That should be the reason to buy Tata Motors, not cars and other issues. Next stock I'll cover is Jindal Saw. They manufacture seamless carbon and alloy steel pipes and tubes in their state-of-art manufacturing facility at Nasik for casing, tubing, and line pipe application for oil and gas sector. They also produce saw pipes, submerged arc welded pipes for the energy transportation sector, and ductile iron pipes fitting for water and wastewater transportation. Consolidated EBITDA came at 840 crore, up 38%, minus 9% Q on Q, was higher than estimate of 780 crore, led by better than expected subsidiary performance. They have a subsidiary in Abu Dhabi, UAE. It reported an EBITDA of 77.5 crore versus estimate of 42.5 crore, backed by improvement in shipments. The current order book for iron and steel pipes and pellets stand at dollar 1.65 billion, that is roughly around 12,000 crore versus 1.53 billion Q on Q to be executed over the next 9 to 12 months. Exports contribute 32% of the order book. The order book in volume terms stands at 1600 kiloton at standalone level. Order book breakup: primarily water segment 70%, oil and gas 25%, and industrial and other 5%. That is why they have this, because of this pipeline which they have pipes they make for oil and gas. So they have a subsidiary in Abu Dhabi, and water segment should benefit from all the Jal Jeevan and other projects which the government is doing. Diversification into almost all types of pipes allows it to address larger market area and thus helping it to outperform peer groups. They did a JV with a company called Hunting Energy Services, so which has an order book of 130 crore. This JV makes oil country tubular goods pipes. Hence, it has also got a lot of scope. What they have done is, I'll show you, EBITDA per ton has improved, and they did around 21,000 crore sales in a year. So order book of around 12,000 gives them 6 to 8 months visibility. So we'll have to see. Now, if you see the quarterly results, this is in millions. So net sales were up 12%, but still below estimate. But Q and Q, they were lower. EBITDA margins have improved. This is the main reason for growth in profits. Profit before tax went up around 65% year on year and 16% Q on Q, basically due to increase in margins, which have improved drastically over the year because of more efficiency. And PAT was up 70%, and EPS Q and Q was up 70%. Net profit margin has also improved. Now, this is their year-wise number. So if you see here, there is a steady rise in sales, but the margins, operating margins were declining. They came down to around 9%, and now they have improved to 16%, 17% because of better efficiency, lower raw material cost and all. And that is giving them leverage, and the EPS and profits have grown. Profits have grown nearly 3x, and EPS have grown from 20 bucks to 52 rupees, and so it is improving. So that is the main reason why the stock has got re-rated. So if you see, but the outlook is slightly subdued. People are expecting around 4-5% growth over the next 1 or 2 years, and EBITDA growth is also constant only, maybe slightly higher EBITDA, and margins are expected to now reach at similar level. Net profit growth, what has happened in this year of 152%, but subsequently it is not really expected to go up much. Now, coming to their expected EPS, they have done 52 rupees this year and expected to do 57 to 60 rupees in next 2-3 years. So not much growth, and ROE is also improved, but it is not expected to go up further because probably if they do higher volumes, they have to require more money as a debt for working capital, etc. So that has to be seen. Valuations are not very expensive. they have come to around 10, 11 P. So that is one which is driving the stock up. Now, if you see here, EBITDA contribution from subsidiaries has improved in last quarter, and that led to better growth. And standalone EBITDA per ton is also constantly going up. So that was driving margins. So now if you see this stock, this is a weekly chart. It was doing nothing in 2023. It was to be stuck at 70, 80 rupees level. And then after 2023, there was a re-rating of this stock, and it kept going up along its 20 EMA. And last week, it went up with huge volumes to 650 levels. So, in my opinion, it is getting now fully priced. So, we'll have to wait for a dip to enter this. But this is a safe stock, though don't expect too much of growth. But at 10, 11 P, forward P, it is not very expensive as such. So, you are counting 59, 60 rupees EPS. So not much to lose as this, it is not becoming a cyclical sector now. It is becoming more of a growth sector. So that is the point. The last stock today is India Glycol. It's again a very interesting stock. It has multiple businesses. We'll see that it registered 41% year-on-year growth in net revenue, 26% year-on-year growth in EBITDA, and 18% year-on-year rise in consolidated PAT in Q1 FY25, better than estimates. Q1 revenue was mainly driven by biofuel business, which grew to 68%. Though other bio-based specialty and performance chemicals, BSPC, also witnessed a healthy 17% year-on-year growth. Q1 revenue from potable spirit PS and in nature biopharma, which is one of its subsidiary, grew by 19% and 8%. Now, what does this company does in nature biopharma? It makes natural ingredients which are plant-based for pharma, nutraceutical, and food and beverages industries. So it's again a rising business. Biofuel, that is ethanol, will remain a growth engine for FY25-26 because of the stated government policy and introduction of value-added products from its new specialty units, commissioning nearly complete, addition of new brands in IMFL, that is liquor, will supplement the growth. The portable spirit business witnessed 19% year-on-year and 13% Q-on-Q growth in net revenue to 280 crore. Gross revenue 1594 crore. Q1 revenue was driven by higher sales volume of country liquor in Uttarakhand. IMFL sales also witnessed strong upstick in UP and supplies to paramilitary. Optimization of 450 KLPD, that is kiloliters per day. Expansion of ethanol capacity is expected to come in H2 FY25. So what is happening is it will grow their biofuel business. Expect a net revenue and PAT CAGR of 16% and 40% over the next 2 years. So that is driving this stock. So now if you see here, the net revenues were up 41% year on year and 5% Q on Q, and the cost of goods sold went up. And because of that, the EBITDA only grew 26% and profit only grew 18%, because the margins declined, because the cost of goods sold has gone up because of number of reasons and packaging cost and other issues. If you see their net segments, the BSPC segment is the key driver of revenues, with biofuels have grown to 68% year on year. So there is increased demand. Non-biofuels are okay, constant 17 odd percent. Potable spirits up 19% year on year. In nature, the other business of natural products from plants is up 8%. So total was up 41%, but basically led by biofuels, that is ethanol. Q&Q also was up, and it is expected to perform well. All these segments are expected to perform well over the next 2 years. So if you see the income statement, which is expected, so they are expecting around 20% growth in FY25 over income, and EBITDA is expected to grow again by 20%, while profits are expected to grow by around 30% once the operating leverage comes into play. So that is a good point. EPS is expected to reach around 90 odd in FY25 from 56 now, and 109 in FY26. So if because of the segments, that is the biofuels and the portable liquor, that is likely to perform well. So if you see the ratios, uh, ROE, ROC are improving regularly. Debt to equity is coming down. Cash conversion cycle is improving, is becoming lesser. EPS is improving. Year on year growth is strong in EPS. And PE is now coming down. And for FY26, at present valuation is around 11, which is not very expensive. Uh, So focus on moment. If the biofuel focus remains, it will re-rate this stock. Now let's see the chart. Remember FY26 EPS is 100 plus. So if you see this stock, after the results came, it has gone up, and was even strong on Friday also, while the rest of the market was correcting. So keep this stock in on watch, and it is not a bad proposition to get this stock on any dip from here, though it is slightly overbought, but it's a good business and not very expensive, and it is not a sugar business. What is happening is those sugar mills who make uh, ethanol, they get sucked in the sugar cycle. So if sugar prices go down, their valuation go down. But this is a pure ethanol business, so that is why this has an advantage. So keep this thing in watch. I finished. We'll take questions now.